Hello, everyone, and welcome to the next installment of our speaker series from Personal Wealth Strategies. I'm very excited today to present to you a speaker from M3 Financial. Douglas Towsey is here to speak about the truth about annuities. As a way of background, Doug is currently working as a director of training and sales development for M3 Financial, but has been in the insurance industry for many years. He first entered the industry in 1998 in the P&C area, or property and casualty area, working with Fleet Insurance. Fleet Insurance at that time was affiliated with AIG. He then moved on to State Farm to work as an advisor. Followed that, he went to work with Allianz Life, specializing with life and annuity products. He spent 15 years there before moving on as a regional vice president at Alliance Insurance Management Services before returning back to Allianz Life. As I said, Doug is now with M3 Financial and will be talking to us about the truth about annuities. I think this is going to be a wonderful presentation because we hear many questions from our clients today in the crazy and volatile markets about what are annuities, why are they a good investment product, why may they not be a good investment product, and Douglas is going to answer all those questions for us today. So Douglas, let me turn it over to you, and thank you for joining us today.
Thank you very much, David. Again, I want to thank everybody for joining us today to talk about the truth about annuities and the myths versus realities, because these are not grandma and grandpa's annuities anymore. These are definitely, they've got many more new features. When you think about insurance carriers, when they're designing annuity products, they're designing them for specific needs, and not all insurance carriers create their products the same. And one of the things that you need to know about annuities is really, in essence, what they're actually boiled down to. The reality of an annuity is boiled down to an agreement between a consumer and an insurance company. In essence, you give money to an insurance company and they provide a guarantee that comes in the form of guaranteed interest, or guaranteed income for a set period of time, or if you choose, for the rest of your life. So they've got a variety of different features there. And the insurance company backs the guarantee of these payments based upon their financial strength and claims paying ability. One thing that is common to any type of an annuity, whether they're fixed annuity or the new fixed indexed annuities, which again are still fixed contracts, or the variable annuities, fixed annuities also provide some additional benefits, like tax deferral on your interest earned, or protection from downside market risk. And we'll talk a little bit more about that in some subsequent slides. And if you're looking for guaranteed lifetime income features, these typically come with an additional cost, known as a rider charge. And they are subject to the 10% early withdrawal penalties if they're taken before age 59 and a half. Now, when receiving income from an annuity, if that's the intent, it is taxed as ordinary income based upon your tax bracket at the time of disbursement. Annuities are created to address several types of solutions, from the type of consumer who wishes to safely accumulate some assets for a specific time frame, or for clients who wish to take income now, an immediate annuity, or income later, which is known as a deferred annuity. And a deferred annuity is typically, it's a combination of an accumulation vehicle until the income is actually needed. There are three different types of annuities, including the following. A fixed annuity provides steady interest rate, credited for a period of time, and they're known in the industry as a multi-year guaranteed annuity. So if you're looking for certainty, this might be the solution for many people. The fixed indexed annuity is a product designed to provide more potential than a stated rate annuity by tracking positive changes of an external index. For an example, the S&P 500. This may provide more interest without risking the principal to market downturns. In a negative environment, this type of product design for interest earnings will mean you'll receive 0% interest in a year when the market is negative. And keep in mind, you are not invested directly in the market with this type of deferred annuity. Now, the variable annuity is designed for clients who want greater returns, but are willing to accept some risk for the return. The variable annuity will be based upon your chosen investment options. This offers more growth potential, but does carry some risk due to investment performance. So, when you think about traditional fixed deferred annuities, due to the current low interest rate environment, the trend of using these low risk instruments are shifting towards other types of annuities. Interest rates are typically declared for a period of time, let's say 5 years, for example. At the end of the period, the company redeclares the new rate, but will always have a minimum interest rate guaranteed, meaning that can't go to, like, say, 0% interest earned. Simply stating, they always have a minimum interest rate upon renewal. And you'll find traditional fixed deferred annuities with terms anywhere from 3 years to 4 years to 5 years. The average is about 7 years out there. So when you think about these type of annuities, they're really designed, for a little bit more of a long-term investment. Now, the fixed indexed annuity, was created back in 1998, and the psychological times back in 1998 was we were coming off of pretty much a down year, negative performance, and the deferred annuities of the previous decade of 7, 8, and 9% guarantees for 10-year periods was all but gone. Now, the fixed index annuity is a fixed annuity. One difference will be the interest rates and caps are declared on an annual basis. And you'll have a choice for a fixed account, guaranteed year by year. And interest can be credited by allocating to that external index, my example of the S&P 500. If there's a positive change to the S&P 500, the policyholder would receive positive interest credited up to a certain cap. Now, the definition of a cap, in a nutshell, it's the maximum interest that can be credited to a policy. An easy example is a positive change in the S&P 500 of, say, let's just say 8%. You may have a cap of 5%. The credited interest in that year would be 5%. You do not receive the entire upside of the index, in this example, because you exceeded the cap. Now, on the flip side, if it is a negative change of the S&P 500, let's say it's a negative 8%, you would see a 0 on your statement because you are not directly participating in the market. You're not taking possession of any type of security. It's this element which makes the product a fixed annuity and a low risk instrument. Finally, with these type of contracts, you can always change your allocations annually. If you feel you want to have more or less of your account in a fixed interest earning strategy, or you want to allocate between several different strategies, you definitely have that ability on that annual basis. Now, practical applications for index annuities, or any annuity for that matter, it's longer term investing. Now, that's a subjective term. Long term to some people might be 3 years, long term to another person might be 10 years. But it's really where liquidity is a minor factor. And liquidity being, money that I have access to. I really don't need to access this money after 1 year. And what's wonderful about this is that it's a great part, when you think of an asset allocation program, you're thinking holistically regarding your own pie of money. This is a great bond component. Most people go stocks and bonds as diversification. But adding in this type of fixed component it can definitely help it, because for a risk-averse client who wants an opportunity for higher returns in a low interest rate environment, this might be a solution for that conservative money. And no matter how aggressive you are, you still have conservative money. So don't think of annuities as contracts designed for conservative clients. It's really designed for the part of the pie that you don't want to lose. Now, keep in mind, it's always best to diversify a retirement portfolio, and an insurance carrier will never allow you to put all of your funds into one vehicle. This is known in the industry as a red flag and is almost always not suitable for a client to do so. An annuity may be suitable for funds which are earmarked for several reasons. Principal protection, you don't want to lose the money. Conservative growth, you don't need to gamble with this money. Or to guarantee some type of income stream, whether it's for a specific period of time, 5 years, 10 years, etc., or for an entire life for you or a spouse. Now, when the need for income is the end result, an annuity can provide guaranteed income with a variety of choices. One of the choices, annuitizing the cash value of the policy. Now, this option will typically provide you the most income guaranteed and generates it as a result. The trade-off for annuitization is the loss of access to the cash value. An easy analogy is to relate this to a defined benefit pension plan. You convert your pension value into equal periodic payments, for your life. This is the same for deferred annuities, which creates the same options. And some of these might be even, an immediate annuity where you need income today and it creates income at the issue of the policy. Now, regarding taxation, first of all, if you have a qualified plan like a 401k, the income is taxed as ordinary income based upon your tax bracket at the time of disbursement. But if you're using non-qualified assets to generate income, like money in a CD, a savings account, a money market, you will receive a tax-favored distribution. It's called an exclusion ratio. This definition is alluding to part of the income payment as not taxable, since it's considered to be a return of your money as well. An example in a broad statement might mean, let's say, a $100 paycheck could have $80 excluded from taxation, and your tax responsibility would be $20 taxed at an ordinary income tax rate. The exclusion ratio is determined by life expectancy, amount of the principal compared to any gains in the contract, and varies situation by situation. But if you don't like losing access to your cash value, and one of the trends in the industry is that baby boomers, they don't want to give up control. So if access to your cash value is important to you, plus you need income, but you also want the flexibility to change your mind, there are so many alternatives to annuitization. The first one is systematic withdrawals. The benefit of systematically withdrawing funds from an account is flexibility and control. The risk to this type of approach is if you're looking for lifetime income, you might outlive your money. There are immediate annuity options with a return of premium. What this provides is a client with a guaranteed income, but if they die too soon, the remaining funds which were put into the contract would be passed to the beneficiary. A benefit of this option is to make certain that the proper person receives a death benefit as opposed to a carrier retaining any of that initial deposit. And then finally, these lifetime income benefit riders were really kind of created for the baby boomers. One of the things that a lifetime income, guaranteed lifetime withdrawal benefit, I should say, it gives the flexibility to stop the payment if you want to, if you need to access additional cash value if needed. What I like about this option is that it still gives you the control. It still gives you a guaranteed lifetime income without losing access to the cash value that you've been building all these years, especially for emergencies. Now, if you're thinking about what type of funds, a lot of times qualified assets, IRAs, rolled over 401ks, are really kind of designed for retirement income. And this might be a good alternative if you don't want to do that systematic withdrawal type of an approach. Now, systematic withdrawals, there's also, while you're in deferral, penalty-free withdrawals, which kind of separates it from many other type of vehicles. A lot of times when you compare this to a bond, if you need access to that money that's in a bond, you have to liquidate the bond. With deferred annuities, many of them offer a free withdrawal provision. And typically it's 10% available after the first year, so that if you have a situation, whether it's an emergency or an opportunity, you could withdraw a portion of that money without any type of penalty from the company. Now, keep in mind, anything pre 59 and a half withdrawals are subject to a 10% excise penalty from Uncle Sam. Now, taxation of annuity withdrawals, last in, first out. In the industry, it's known as LIFO. All that is saying is that they're paying out the interest first before getting to your principal if you're utilizing non-qualified assets, money from a CD to roll over into this. And when you think about identifying opportunities, there are really only four kinds of money out there. Money you need immediately. This is cash, savings, checking, money markets, stuff that you can access because you need the money right now. Money that you need in a couple of years, short-term bonds, CDs. Money you'll need in 3+ years equals stocks, equity mutual funds, annuities. Or when you think about legacy money for heirs or for charitable organizations, money that you'll never need is really kind of designed for life insurance if you've got that human capital of being insurable, or annuities as a way to use that as estate planning. And when you think about how do fixed annuities compare with CDs and munis and bonds, when you think about the 11 choices that you have in front of you, many of these annuities out here offer everything. A return of principal guaranteed, tax deferral, which is great for non-qualified assets, a guaranteed death benefit, and you'll avoid probate. Anytime you write down a beneficiary on a form, you're making certain that you are estate planning and avoiding the cost of probate. Guaranteed lifetime income is really one of the only vehicles in the industry right now that can actually guarantee you lifetime income, even if you exhaust all the funds in the underlying portfolio, which you can't do with CDs. Muni bonds are not guaranteed. Liquidity, they all offer liquidity. There's tax advantage income options that I mentioned earlier. As a matter of fact, tax liability on Social Security eliminated during deferral. If you have questions about that, definitely reach on out to David. It eliminates 1099s while you're in deferral. Many times you might have a mutual fund that kicks off a 1099, even in a year that you've had negative returns. Protection from creditors. Now, this varies by state, and I'm not actually up to speed for the state of Maryland and New Jersey and the East Coast here. But of course, if you're ever looking for spending down of assets, a lot of these carriers have these provisions that kind of protect you from this. So these positive answers, when you compare everything, fixed annuities offer a lot if you have the ability to actually invest it for a little bit of a longer term. Now, there are some new innovations that are in the marketplace, and insurance carriers are constantly updating their product offerings as they identify additional needs or trends regarding demographic shifts. One of the trends was baby boomers don't like annuitization. One such need that was identified was the need for increasing income to help with the rising cost of retirement expenses, whether it's from the cost of goods increasing, health expenses, increased taxation, taxes are at a discount right now, or spikes with inflation. A variety of insurance carriers are offering income options which rise with the inflation for a specified period. One such carrier does it for 20 years. If inflation rises, so does your income payment. So it keeps your cost of goods basically static. Or there's some carriers out there that if you earn any interest, they apply it to your paycheck. This type of option comes with an increase in income feature for life. Even if your assets are depleted down to zero, let's say you have a long life expectancy and the market performs, they're putting interest on your paycheck to give you pay raises every year. But one of the most recent features that were brought to the table over the last few years is a benefit that's designed to address tail risk, which when you think about tail risk is chronic or critical illnesses during retirement. Some insurance companies offer the ability to increase your annuity check by 1.5 times or even double your income based upon the inability to satisfy certain activities of daily living. Many of them don't even do it with underwriting. And some of them even offer this benefit for free because it's designed, to kick in for somebody who's looking for income down the road. Some of them might charge a couple of basis points. But, when you think about innovations in the marketplace, the fixed index annuity back in the late 90s when it came into place helped many clients avoid what was called the lost decade. 2000 to 2010, we know about all the ups and the downs where they didn't lose that protection. And when you think about income, prior to retirement, there's about a 5 to 10 year retirement red zone, which I believe is a prudential term from way back in the days. But where you want to start taking some money off the table, and potentially that might be some of those retirement assets. But, at this moment, I mean, that's really the truth and the myths about annuities in today's world. I would love to open it up to, any type of questions if you have any, David.
Sure, Doug, that was a great presentation. Thank you very much. I know we get a lot of questions about annuities, probably more so than any other product. And I'd like to start. We talked a little bit about the fixed indexed annuity, and I think that's one where people don't quite understand how it works. So can you spend a little time again going over the idea of what happens in a down market? And how there's protection in place for them?
Certainly, and that's the biggest benefit of an indexed annuity. It was really designed to get you better than a fixed annuity. It's not designed to beat the market. But the example would be, let's just say hypothetically, the S&P 500 today had a closing ending value of 1,000. So if you purchased a contract today, and at the end of the year, let's say the S&P 500 is down 10%. So the ending value is 900. Well, if you were exposed to the market, you would lose 10% of your principal. In an index annuity, it's that portion right there where you would return a zero. And you don't have to reclaim any lost interest. If you lose 10% of your money, you need 11.5% to break even. If you lose 20, you need a 25% return to break even. If you lose 50%, you need 100% return just to break even. So you never have to go backwards. The benefit of these contracts is in the subsequent year. Let's just say that same 900. So now I'm in year 2, and it goes back up to 990. Now that's just indicative of 10% positive change. You would capture that upside up to that cap that I mentioned earlier. So the trade-off is you may not get that full 10%, but you might get 5 of it. So you didn't lose 10% the previous year, you remained flat. The next year, you would gain 5% because you were positioned for that rebound year. And that mechanism is really called annual reset. And it's built inside the contracts that eliminates the down years, and it allows you to lock in the gains in the years where it's a positive performance.
One of the objections that we hear sometimes when people first look at these annuities is that it sounds too good to be true. I get the ups, but I don't get the downs. And of course, the secret is the cap on the up is where the insurance company is able to make money to hedge, which may be exactly what you as an investor want to do, but don't have the skill level or the expertise to be able to do that. So you're locking in the highs, but you're preventing the lows.
Oh, exactly. And a lot of people, what we try to do with our portfolios before this type of vehicle came out, we may have played with our own portfolio to try to hedge against some type of downward risk. Maybe put a bond component in play with the stocks or with the mutual funds, etc. But what's wonderful about this is that in order to eliminate the downside market, they can only give you a certain portion of the upside. If you want all of the upside of the market, then you go into the market. But that opens up that downside risk. So that's that trade-off where, if the market returns 6 and you got a cap of 5, you get the full 5. The market returns 4, you're within the cap, you get the full 4. If you're negative, they eliminate it.
And one of the things that's really critical, and perhaps you want to comment on, is for a retiree not having to, when you're taking the withdrawals from your annuity or whatever investment you have, that when you have a fluctuating value, that in a down year that withdrawal hurts more than it would than the upside can make up for. So I guess what I'm saying is that when we manage withdrawal features for clients, we're trying to cut down volatility, and the fixed index annuity really does do that.
It does. I mean, it's almost a self-regulating type vehicle. I've always used the example. Many clients, what they do is they're reading CNN.com or they're looking at the Wall Street Journal, and they see this thing that's called the 4% rule, which is the income rule of thumb of, if you're managing your assets, you put all your assets in a pile. Let's say it's $1 million, and if you access it at 4% per year, if you invested soundly and you didn't have any market corrections, the money should last you for the rest of your life, but we know that's not the case. The example I always do is if you have $1 million and you take 4%, that's 40 grand. Now you're down to $960,000, but what if we have another financial recession or volatility comes into play and you lose 20% that year? Well, your 960 drops all the way down to now this is mathlete type stuff, so it's $780,000. Well, are you still going to take your $40,000 or are you going to adjust downwards at 4%? These annuities out there, their lifetime guaranteed payout rates at age 65 are starting at 5%, and right out of the gate, they're kind of beating that.
Yeah, that's a great point. In fact, that takes me to my next area, which is the guaranteed lifetime withdrawal benefit. Historically, I know when you started and when I started in the business, people would shy away from annuities because the biggest concern was if I give you $1 million in your example and I die tomorrow, my family gets nothing in return. But with these guaranteed lifetime withdrawal benefits, that's no longer the case.
It's not, and that's where carriers are constantly adjusting, and when they see a demographic shift, they have to start adjusting their benefits. And when they start realizing, and it started with the baby boomers. The baby boomers, I'm one of them, we want it all, and we want it all right now. And we don't want to give up cash value, especially if you don't have a pension, your 401k, you're used to being able to see that money and know that's yours. But these benefits nowadays, these guaranteed lifetime withdrawal benefits, if you die too soon, a lot of times it's a return of principal, or you get all of the gains if you passed away too soon, whatever the account value is passed to the beneficiary in a lump sum. That's a big change from 25 years ago. And then these lifetime withdrawal benefits, now there are charges for these. I've seen charges in the industry anywhere from 40 basis points to maybe 1.5 points. But that fee, what it's buying you is the guarantee that even if you do live too long, not too long, but you have a long, healthy life, what'll happen is that if you ever do exhaust that $1 million and let's say you're age 93, well, at age 93, if you're doing it yourself, you're broke. With these contracts, the guarantee is now saying, no, you're still going to get this payment, even though the policy value went all the way down to zero. These new contracts out in the industry, it really has changed, the new normal, basically, which is, the three-legged stool of income planning is all but said and gone if you don't have a pension.
Yeah. That is so true. It really becomes incumbent on the individual to make sure that they're taking care of themselves, because if they don't, nobody else will.
True.
You mentioned the cost factor, and you talked about 40 basis points. And for those who aren't familiar, basis point is 100th of a percent. In the world of finance, 1% is such a large number when you talk about things like the cost that we actually break it down to hundredths of a percent, and the basis point is the measure. But much of the literature out there from pundits will say you have to stay away from annuities because the expenses are so high in the annuities. And I know when I talk to clients about it, I would say it is a more expensive investment than some other options that are out there. But that money goes for some purpose, goes towards the guarantees. Do you find that being an obstacle for people, that they get caught up more on the expense side and don't give adequate consideration for the guarantees?
Yes, I have come across that, and I've come across that for years. And one thing that I always try to remind people is that a fee provides value, but you have to know what the value is actually giving you. There are annuities that are out there with some pretty high costs, but what is it buying you? It's probably buying you greater performance, maybe higher upside. But in the fixed index annuity space, because you're not directly invested in the market, you don't have all these extra charges. All you're really paying for is going to be this lifetime income benefit, and that's why you see the costs on these type of contracts much lower than many market-driven type vehicles. And the reason why they do that is because an insurance carrier can pool risk, life insurance, cars, etc. The pooling of risk means that they can kind of bring the cost down, which is a great vehicle, which is often overlooked. But fees do provide value, and the thing you always want to know is, can it change in the future? An index annuity at time of issue, if you're locked in at 40 basis points or 1%, that's guaranteed for the life of the contract, and it's never changes. And that's what I like about the fixed contracts.
It is interesting now that we've seen in the development of annuities, there's so many carriers and so many different options that a client could really, from almost like an a la carte, choose what is it that I want to pay for, what do I want guaranteed, and what is it that I'm willing to forego because it's not really relevant to me.
Mm-hmm.
And the importance of working with a good advisor is somebody who can ask the right questions and help identify the right product. And I know a company like M3 is real important to us because they do offer so many different options for our clients. So it is my pleasure to have you give us this presentation today, and I thank you very much, Doug. Should anyone have any questions, you're always able to call us in our office, and we're able to walk you through anything that you might need. And Douglas is always available to us as a resource should further questions arise. So I thank you for your time and your presentation today, and I look forward to being able to do this again in the future.
You're welcome, David. Thank you very much.